Money line, I'ma run it every time. Give me mine, going up, need no decline.
Hello, UAE Grow Your Finances community,
where we discuss how to make your money work for you as opposed to the other way around, and how best to grow your finances in the UAE. Here, we like to flip challenges around and create ideas, opportunities, and possibilities so that we can all succeed together, because there are enough seats for everyone at this table. How are you today, Russ?
Amazing.
That's fantastic to hear. Today, we have a guest who you might know from our Facebook group,
Who might have a different perception to invest in than we do.
Yes, he is our number one contributor on our group, our top contributor. So you might have guessed who it is by now. It is the one and only Elie from Wise Investor ME. And he is also an admin on the group Simplify, which we see spoken a lot about on social media. And actually, when people complain about the cost of living here in the UAE and ask how they can save better within the UAE, it's usually two groups that are recommended: Simplify and UAE Grow Your Finances. And we're here to say that we recommend them both. We're on the same page. Simplify and UAE Grow Your Finances, we're on the same page. We have a little bit of a different approach simply because Simplify covers mainly ETF investing, and that is what Elie is the expert on, and he will speak all about that today. And UAE Grow Your Finances, we cover a broad range of investing, and as well as like money mindset, and we go into the psychology of it, and we cover it more broadly and explore it a little bit deeper and further. Where Simplify is more science-based, factual, ETF focused.
And predictable.
And predictable, which you want it to be when you're investing. But at the same time, we say this is more for your safe, solid foundation. And for some people, that's all they want and need. For others, they have more of a risk appetite, as well as they actually enjoy the world of investing and getting involved with other things and other possibilities and other projects and exploring a bit more. It just depends on what type of person you are. But that leads us to our discussion topic for today. Elie made a very interesting comment during our interview with him, which you'll hear in a little bit. And Ross was speaking about a little bit of a riskier investment, and Elie said, well, why don't you just go to the casino and gamble? And that made us giggle a little bit, because Ross would love to do that. You know, he likes a little bit of risk and having fun with his money and all of that. But it also made me think, can riskier investments be compared to gambling? So that's going to be our discussion topic for today. Ross, are you ready to make finance fun?
Absolutely.
In 3, 2, 1, fun. So Russ, what do you think? Are the more risky investments equivalent to gambling?
For me, I have a different perception on this, as I normally do. When it comes to investing, there's no black and white. Yes, if I go and I put my money on Forex, let's say I buy USD Euro Forex, for example, and I have no training on how to play Forex. I don't know how to do it. I don't know whether it's going to go up and down. I don't read the news, nothing. That's gambling. But if you have a perception and you know something is going to do well, yes, there's risk involved in every investment, including ETFs. However, if you invest, you need to know what you're invested in, first of all. You need to do your due diligence because it's so important. You need to know everything from A to Z about the investment if it's a more risky investment. And that's what I do. For example, when I refer to private equities, I know the people running the business, right? I know who they are. I know what their mission is. I know what their vision is. I know what they want to achieve. And if someone says to me, you can times your money by 4, in 2 to 3 years. And I believe in that because of the research I've done on the company, black and white, the numbers, the projections, people running the business, and everything about the company. If I personally believe with my confidence that this business is going to times by 4 on a limited scale, it could times by 8, it could times by 12, I will take that risk.
Yes, it's a calculated risk.
It's 100% a calculated risk. And the reason why I take these calculated risks is because for someone like me who's 32 years old and wants to retire by 40, how do I do that with an ETF investment? For me, I need to diversify, yes, into ETFs because it's a safe bet. However, what my plan is, like I talk about all over the group, I've invested in 3 businesses. This is private equity only. This is the private equity side of my investments. I plan to times them by 4, 6, 8, whatever it does within 3 years once the company exits, and then take at least 50% of that and plow it into ETF investments. So that's my plan, right? My plan is eventually to diversify into ETF investments. But if I put all my money now into ETF investments, I need to work until I'm 50, 55, possibly 60. And I'm not going to do that.
That's not the goal.
So you have people that have a short-term plan. You have people that have a long-term plan. And you have people that are willing to take that risk to succeed in their goals. And then you have people that are not willing to take those risks because their goal is not to retire early. Their goal is to work until they're 60 years old.
Do you think that your private equities are a gamble?
I think that 1 out of the 3 was a gamble. I will say that 2 out of the 3 were a gamble when I invested in them. But as the company establishes himself a little bit better, as those leaders of the company that I strongly believe in ensure the investment is a safe one, then it looks very green. Honestly, at the moment now, I'm looking very positive with my private equity investments. And without a doubt, they are going to do the minimum or even more than what I think that they're going to do.
Let me ask you this. With your private equity that you say you thought was a bit of a gamble at first, one of them, what was your chance ratio of success versus failure, of losing money versus making money?
I would say it was a 50-50. It was money on red.
And if you walk into a casino, what are your chances?
If I put it on red, my chances around, I think, 33%.
And how much do you stand to make?
In the casino, you make 100% profit. So you times by 2.
How much do you stand to make on this investment? This one that you thought might be a gamble?
It could go to 100 times.
So it's not a gamble then. It's not a gamble. It's not equivalent to walking into a casino and gambling.
Correct. It's correct. And the reason why I invested in that one that I believed was quite risky at the time is because I know the founder and CEO, and I know this guy will not just sit at home and cry about losses in the company. I know that he is going to work 24/7. He is going to bust his ass to make sure the business is a success. We know him personally, me and you.
Yeah.
So that is the reason why I took that bet.
And also you have a spirit of entrepreneurship, so you recognize it in other people, and you know the type of entrepreneur who doesn't take no for an answer, who pushes boundaries, who keeps going, who has all the qualities that it takes to create a very, very successful business.
I would also like to add, I don't want anyone going around and putting 50% of their money on their private equity that could make money, could lose money, you know. This is a risky asset investment to do.
Yes, and great private equity opportunities don't come by very often.
Yeah. I would also like to add, it was a very small investment that I made on the risky private equity. Okay. Around 70% of my private equity investment is in the 2 companies that are a lot more stable and a lot more chance of making money than the one that I put that is a lot riskier.
I do not think that it's an accurate comparison to say that riskier investments are equal to walking into a casino and gambling. I think that's two very different things. I think that casinos function in a very specific way and investments are a completely different ballgame. I understand the saying and the sentiment behind it, but the two just simply cannot be compared.
Correct. Because what about that person that invested in Apple when they were starting out? Do they believe that this is like throwing money on red on the roulette table? Absolutely not. Because they made hundreds and hundreds and hundreds of times their money.
And you stand to make far more when you're investing. You stand to make far more. You have a far better chance of making far more money than in gambling, as well as you're not just throwing money out with the hopes that you're going to hit it like you do in the casino, because you're throwing a lot more money out than you're actually getting back a lot of the time in a casino, most of the time in a casino. It's simply not comparable, in my humble opinion. Having said that, I'm also the type of person who loves to take the lottery. I'll take the lottery and I do believe that one day I'll win. So gambling, I have no judgment on gambling. I have no judgment on it. It's not haram for us personally. And I have no judgment on it. Actually, I think it's really fun, as well as I think it's great for manifesting because it gives you that energy of possibility, that energy of hope, that energy of I think I can do it, I deserve it, and that money can come to me easily. It encourages that thought pattern, as long as you're not taking it very seriously. However, one thing you should take seriously is your investments and doing your due diligence and researching. And investments you have some form of control over because you are able to do that. There's information available, there's data available. You're backing a person who has created businesses before.
Absolutely. And if we look at ETFs and then we look at other investments, there's so many different categories of investments. And that's why our group is a lot more diverse, because we speak about anything that can possibly make you money, right? And we don't shun anyone that is doing something risky, something safe. We don't shun anyone. We want everyone to join the group and share with us what they are doing, because we are all learning together. That's why we do not see the other financial group as a competition, because if I can go on that group and I can learn something from them, it would help to post it on my group.
As well as they are active in our group, helping our members learn about ETFs, which is very much appreciated because that's knowledge that everybody needs.
Correct. And on to ETFs. I'm super excited about this episode because I've been flirting with the idea of ETFs. I believe that they are the safe investment. They are the investment that you put money away for your kids. They are the investment that you put money away to financially become free.
Boring, and they have a possibility of bringing you a lot of beauty too.
Yeah, because at the end of the day, most of the boring investments are probably the safer way to do things, right?
Correct.
And a lot of people have lost a lot of money not playing the safe card. So please, guys, please don't listen to me and go and do all these risky investments. You need to decide what works for you. For me, currently, a 60% of my portfolio is a little bit more risky at the moment, which is a huge percentage, but this is the confidence that I have in that 60% of those investments.
But I also want to say that that is excess money that you have to play with. That is once all your expenses are covered, your payments are covered. It's the money that you've saved month after month on excess.
Correct.
So it's not money that you cannot afford to lose. This is very important. You hear that all the time, but it really is money that you choose to play with, just like you would choose to spend it on a luxury designer item. You choose to spend it on a risky investment instead.
Correct. But like I said, I've done the correct due diligence. I have spoken to the correct people. I have all the information I need to make that decision. So for me, it's not risky, but it's a risky asset class. And that's what I need to help the listeners understand. So a risky asset class is like your Forex, is like your private equity, is like your individual stocks on the stock market, is anything that overnight you can lose everything. For example, if I invest in a private equity and tomorrow there's a huge scandal in that company and the company goes belly up, so does my money, right? Forex, if there's a huge financial crisis and I have money on whatever Forex I have it on, and I'm playing the margin game, which is most of the time that's what you do in Forex, I will lose it overnight, right? Individual stocks, if I invest in Apple and Apple goes belly up, same, I lose all my money. So these are considered as risky asset class investments. But
You believe in taking them because the opposite can also happen.
correct. And I believe that the opposite will happen in the investments that I have taken.
Which you guys will find out in a couple of years' time. So stay tuned to see the outcome of Ross's risky investments. Risky in inverted commas.
I would also like to say, after speaking to Elie during this podcast, I have gone ahead and I've invested probably around 4 or 5% of my entire investment portfolio into ETFs the same week.
Yay! Woo! Thank you, Elie.
Because Elie is a great guy. Elie we had a lot of fun with, and finally we met Elie. Because it's been a lot of conversations, and finally we met him personally. He's a great guy. He knows what he's talking about in this area.
Very knowledgeable.
And he's got a fantastic YouTube channel, so please go check it out and subscribe.
And with that being said, let's just get straight into the episode. Ross, are you ready to make finance a little bit more boring? Just kidding. We had fun with Elie. Ross, are you ready to make finance fun?
Absolutely.
In 3, 2, 1.
Fun. Welcome, Elie. It's great to have you on our podcast. I would say finally to have you on our podcast. Elie goes back a long time ago. He's been in the group for... How long have you been in our group?
I think for a couple of years, if I'm not wrong.
I think from the start. I think
You might not know this, and Ross, you also might not know this, but you're actually our top contributor in the group. Number
cool.
one. Number one. So thank you.
Thank you. Thanks for having me.
Yeah, and I see our members really value your input and advice. So we're really happy to be speaking to you and getting all your thoughts.
Thank you. Thanks for having me.
So who is Elie and why are you so passionate about investing?
That's a very good question. Who am I? I'm just a regular person. I'm actually not into investing at all. I'm an IT professional by trade, so to speak. How did I get into investing? Because one day back in 2017, if I'm not wrong, I woke up and I just realized that I don't have a plan for retirement. So I just thought that if I lose my job or if I just stop working the next day, I didn't have enough or I didn't have a plan in place to support myself and my family in retirement. So I understood that I was totally dependent on my job and that wasn't good enough for me. So I need to have some sort of passive income. And by having some sort of passive income, you could support yourself in retirement. Now, the thing is, once we are expats in Dubai, you lose access to your pensions, to your any sort of government-backed pension plans back home. So the thing is, the minute you lose your job or you simply get out of the job market, you basically have nothing to support you. And that was like a big alarm to me, and it was a big wake-up call. So I started to read and educate myself on how to build some sort of a money-making machine to support myself in retirement. I started with Rich Dad, Poor Dad. I believe this is one of your favorite books.
Absolutely.
And then I continued with another book, and I ended up reading more than 30 books on personal finance and investing. So, which is something I never had. Before reading, I never had any clue whatsoever about stocks or investing or ETFs or any of that stuff.
What compelled you to keep reading, to keep going on to the next book, the next book, the next book?
I would say it's a hunger to learn more. But then after I read several books, I started seeing a recurring pattern, right? So at some point in time, I stopped reading anything new because I just realized that once you, I wouldn't say master, but once you understand the core or the concept of how to invest effectively using the my favorite investment strategy, maybe we'll get to talk about this later, then that's pretty much it. There isn't much you could learn or do to optimize it.
Yeah.
Because at first I thought that maybe by learning more, I could do better. But then I realized that it was just a mirage. And I mean, once you get the basics covered, that's pretty much it.
Yeah.
So once you got to that 30 book, you thought, I'm just learning the same thing over and over again.
Exactly. Now you get to learn like new tweaks and different aspects to the same thing, which is still interesting. And me being I would say an investment, I wouldn't say guru, an investment, what's the right term for that? Enthusiast, kind of, yeah. So it was interesting to learn more and to understand the nitty-gritty details of the things you need to do. But like the typical Joe doesn't have to go through any of this. And this is something I realized after reading maybe a couple of dozen books down the line.
Fantastic. I would like to go back to the point you mentioned about we are expats in this country. At the end of the day, we're not in our own country. We are basically guests in this country, and we don't have that fallout plan, you know, that plan that if you lose your job, there's just a pile of cash waiting for you and that you will get paid out on a monthly basis. However, we do have so many perks that allow us to make our own decisions. I would say the tax-free living, the benefits that we get here are fantastic. Definitely, I would say, of our own experience, are much better than what we would get back home. So it's so interesting that you said that, because we should dive into this a little bit more, because I speak to a lot of people on a daily basis. And I would say around 60 to 70% of them rely on their job to get by.
Totally.
And we need more education around this, you know, because at the end of the day, people lose everything they have when they leave their job. And our jobs are here to give us the resources so that we can plan effectively when it comes to financial beings, you know?
Correct. In fact, what's interesting is that you see a lot of executives with a high income, and these kind of people live a very lavish life. But the thing is, once they lose their job in here, they have nothing to fall back to. So overnight, you go from partying all day, brunches, what have you, parties, etc., a couple of exotic cars, to having nothing at all to rely on. So this is the curse of being an expat, as opposed to, so yes, we have a lot of advantages, tax-free and what have you, just mentioned a couple of advantages. But then again, if you don't plan, then you will end up basically with nothing to fall back to.
100%. I mean, it's not about how much you earn at the end of the day. It's about how much you can save.
Totally.
We haven't been our whole life conscious of this. I would say that when COVID came, that was really the ticking bomb that set our savings and investment plan going, and how we're going to retire early and let's get into it and so on. And it was also the birth of the group. So for some people, COVID obviously was terrible. For us, it was also really, really bad. However, financially, it was a good thing for us.
It was an opportunity. Often through crises come opportunities. Yeah.
100%. And so obviously, we all know that you are a definite ETF investor. And we would love to get into it on this podcast about ETFs, what they are, and the basics around it. Because people feel that they don't have the knowledge to get into ETFs because they don't understand it.
Right.
It's not as easy as signing onto a platform, invest in money and get in maybe in passive profits every month or what. So it's a bit more complicated. So could you take us through what is ETFs and what is it all about?
Sure. Before covering the topic of ETF, let me start with the why, or why we're doing all of this. Like we said, this is to build a money creation or money generating machine to support us in retirement. So the key here is to have some sort of passive income. So after I started reading, I discovered that there are three major sources of passive income. So one being investing in, let's call them the financial markets. It doesn't have to be ETFs. It could be stock, bonds, even crypto, etc. So let's just call them the financial markets. So this is one. The second source of passive income would be buying and renting out real estate, which is by far the most popular way of generating passive income because people understand real estate, right?
And stressful.
Well, yeah, it could be stressful. And the third kind, which is possibly the most stressful source of passive income, is when you build your own business. Now, this is maybe not for everyone, but if you could build your own business that can generate money. And now let me clarify a point here. I mean, you could have your own business. Let's say if you're a consultant and you need to be active and you're the star in your company or in your solo company or your solopreneurship, or so to speak, that's not really passive income because you have to work to generate income. So that's great. It's great to build your own company, but by creating a passive income company, it's like, let me give you maybe a simple example. It's like you invest in a restaurant where you hire a chef, some waiters, maybe a restaurant manager to manage the restaurant for you. And then maybe you just, check on the business once every month or so, just to make sure that everything is going fine. Now, this is a passive income. This is your business that generates passive income. So the idea is to create something that does not require your direct time and involvement, and that counts as passive income. So again, to summarize, the three types of passive incomes are investing in the financial markets. Number two is real estate, like buying and renting out real estate. And the third stream is building your own business, particularly a business that does not require your direct involvement or your intensive involvement. Because to be fair, any business would require involvement in one way or another. But as long as you don't have to be in, day out in the business, that still counts as a passive income. We understand that the stock market always goes up. Over the long term, at the very least, it always goes up, despite sometimes having some drops along the way. But over the long term, it always goes up. But then again, what if I retire and a severe market crash happens? There's a lot of what ifs.
Yeah.
So in an ideal world, I would say if someone could diversify across all these three streams or different streams of passive income, the more, the merrier.
That's really good to touch base on. Because I myself, I'm sure you already know, I invest quite heavily in private equity. Mm-hmm. Okay, so along the lines of private equity, it doesn't get, I would say, more passive in terms of owning a business or whatever than actually owning a piece of the business, But obviously it comes with a lot of risk. Me as a 32-year-old, I still have quite a few years in my career, and I decided to take a risk into 3 different private equities. I would never invest the amount of money that I've invested in private equity when, let's say, I'm 38 or 40 years old. But I know that the risk is something that is going to give me a lot of reward. And if it doesn't, at the end of the day, I'm still young and I can get back on track.
But I also want to add here that you always say, first and foremost, you must have a safe, solid foundation before going into those ventures.
Correct.
And that's where ETFs comes in.
Correct.
To the conversation, is that this is a part of the safe, solid foundation. Correct. And building that first and foremost. So I just want to make that very clear to the listeners that it's very important to first have that before you go on to take risks.
100%.
Oh, yeah.
Because my end goal when it comes to investing, let's say in these 3 private equities, once they have given me what I want them to give me and I sell them off, my plan is to diversify into ETFs because I have done it before. I didn't understand it fully before. I still don't understand it fully, and that's why
After today we will.
And that's why I'm very happy that we are here to have a chat about it. I know we've tried to chat about it. Maybe my stubborn mind didn't want to listen to it then, but definitely ETFs. I would say 50% of the people invest today in ETFs. Right. So what is ETFs? What is it?
I was getting to that. So just to continue with the idea of generating passive income. So like I said, I wasn't into creating my own business because I'm not into that. And again, I'm not into real estate investment because I didn't have the capital to buy, because of course you need to have like a down payment and then you get into mortgage and whatnot. So again, I have absolutely nothing against real estate or building your own business. If that's your thing, like I said, diversify across all these 3, that's perfect. But the thing is, the reason why I prefer to invest in the financial markets and into ETFs in particular is that it has a low entry point. So you could start with like technically with $5, like 20 dirhams or something like that. So it really has a low entry point. And the thing is, we have tons of studies that show that it actually works. It doesn't work overnight, so it's not a get-rich-quick scheme. So let's be very clear to your audience about that. It's not a get-rich-quick scheme. It's something that requires time and consistency. And we'll get to that in a second. So why ETFs? So I understood that after I started reading about investments and the stock market, my initial thought was I needed to invest in the stock market. And when we talk about investing in the stock market, the first idea that comes to mind is like, you see those people sitting in front of a screen with some complex charts and they're buying and selling like crazy. That's what I thought stock market investing is all about. But then I realized that this is all a mirage. So what Wall Street, or let's say what the financial industry is trying to sell, is basically a mirage that actually doesn't work and that actually benefits the industry rather than you and I as the actual investors. So I discovered that the best way to build wealth is to invest in the entire stock market. Now, why? Because if we look at the stock market history, we have close to 2 centuries, more than 150 years of stock market history that shows us that the stock market rises over time. And when I say the stock market, it's not just a single stock or a single company, it's the aggregate stock market. So it's like if you take all the companies in the world, over time, the industry, the economy rises, and basically a rising tide will rise all boats.
More money is created.
Exactly. So basically, the stock market on aggregate rises over time. Not every year, not every day, and definitely not every hour, but it rises over the long term. Great. So that was a big aha moment for me. Yeah, great. So the stock market rises and the aggregate stock market rises over time. So how do I get to invest in the stock market? So like I said, initially, I thought that it's about buying Apple stock and Microsoft stock and those big names, and then maybe trying to sell them at the right moment. So you have to decide, you have to guess when to buy and when to sell. It gets so complicated. And after reading and after getting to read those academic studies that were done by Nobel laureates, I discovered that none of that actually works. Well, let me be very clear here. Maybe it works for some, but it's a fluke, right? Yeah. So you could, maybe someone bought Nvidia stock a couple of years ago, probably 10x or 50x his money. But then again, he has to buy it at a certain time and then to sell it at a certain time. Yeah. And good luck guessing those times. So you might get lucky once or twice, but the thing is, it's exactly like walking into the casino. If it works once for you, you might want, our gambling part would like to go back into the casino. And as we probably know, the house always wins, right?
Correct.
So since the house always wins, why don't we invest in the entire house, which is the entire stock market, which, as we said before, it rises over time. So the best way to invest in the stock market is to buy the entire stock market. Now, how do we do that? Do we go about buying 5,000 or 7,000 stocks from around the globe? It's impossible. Luckily for us, several decades ago, John C. Bogle, also known as Jack Bogle, created the index fund. The index fund is basically a fund which basically pools money from investors and invests following a certain stock market index. Let me explain. I'll explain with the most popular index that I guess most of your audience or most of your listeners have heard about, and that is the S&P 500. The S&P 500 is basically the Standard & Poor 500, which is an index. It's the representation of the top 500 companies in the US. The Microsoft, Apple, the Teslas, all the big names that are publicly traded exist in these 500 companies. So this index that was created by Jack Bogle simply bought in a certain fund. So he created a fund that simply bought all the components of that S&P 500 index. And this S&P 500 index, which is, like I said, it represents the 500 largest companies in the US, that kind of represents 85% of the total US stock market.
Oh, wow.
So by owning this index, you are practically owning 85% of the entire US stock market. So that was one example of an index fund. There are multiple other indexes. For example, there's another index that tracks the 6,000 companies in the US, or close to 6 or 7,000 companies in the US. And there are global stock market indices that actually track the entire global stock market.
Oh, wow.
So going back to the ETF, so that is the index fund that was created by Jack Bogle. However, we as expats do not really have access to invest in those funds. So these funds are primarily available for Americans, possibly for UK residents, and maybe for Australians, if I'm not wrong. But unfortunately, and maybe Canadians, to be totally fair, but
Definitely not South Africans.
it's actually these, with the exception of these 3 or 4 countries, if you live in any other country in the world, including even if you're an expat living in any other country out of these 4 countries, you cannot buy index funds directly.
Wow.
However, the next best thing are ETFs. So what's an ETF? An ETF stands for Exchange Traded Fund. So it's a fund that typically tracks an index, just like the indexes we discussed earlier. So again, there are index mutual funds available for Americans and maybe for UK residents. However, the rest of us don't have the luxury of buying or investing in any of these. So the next best thing for us is to open a trading account where you could buy ETFs, let's call them baskets, that represent similar indices or similar index like the S&P 500, the Global World Index, etc., etc.
Would it be like a copy trade type thing? So it copies the buy-in and sell-in of that?
It's a good question. It's not exactly like copy trade, because I know that there are some platforms that do copy trade, but I honestly do not recommend people to get into these. And I know that many get into these because they think that, oh, if I look at some successful traders, if I get to copy them, I get to make the same profit as they are.
Yeah.
Don't get into that. It's a mirage. It doesn't work. Again, arithmetically speaking or mathematically speaking, it simply doesn't work.
Yeah.
So
it works at some times and it doesn't work at others. So.
Until it doesn't.
Yeah, exactly.
There you go.
Exactly.
So going back to the question, does it copy the index? In a sense, yes. The way an exchange traded fund is managed, there is no fund manager, because the traditional fund is a fund, again, that pools money from investors, that is typically managed by a fund manager. And this fund manager is supposed to be, of course, he's supposed to know what he's doing. And this fund manager typically has an army of analysts, economists, and basically the best minds in the industry. And these guys are supposed to be knowing what they're doing. So what they used to sell before is like, come and invest with us. We have a mutual fund, or it could be a hedge fund, because we know what we're doing. Instead of investing in everything, the good, the bad, and the ugly, we will pick the best stocks for you and you will benefit more, right? And for the uninitiated, it makes sense, right? So if
it sounds appealing.
Yeah.
it sounds appealing, because if a professional money manager is investing money for you, he possibly knows what he's doing, right? However, funnily enough, and study after study after study have shown that basically these fund managers consistently fail to outperform, they fail to match, let alone outperform the index or the benchmark or the entire stock market. So why do I have to pay money to these guys that will basically take a portion of the cake? So you end up paying them or overpaying them for underperformance. Yeah. So the idea is, instead of having those fund managers managing the fund for you, ETFs, it's a automatically, or I would say systematic fund that simply copies, like you just said, the composition of an index. Let me give you an example. I'm just making this up. Let's say Apple represents maybe 10% of the S&P 500. So basically the fund buys 10% of the fund money, so to speak, in Apple. And then if Google represents 4% of the US stock market, then the fund buys 4% of Google. The same goes for all the other components of the remaining 500 stocks. So basically, the index fund or the ETF simply mimics the composition of the index, or the
US stock market.
Yes, yeah. we're giving the example of the S&P 500, which is the US stock market, because people hear about the S&P 500 all over the place, and it's a familiar index. Mm-hmm. So The ETF simply, I would say, it's an algorithm that basically decides what to buy and what to sell. And usually the components of the S&P 500 do not change that much over time. Yes, they do change every once in a while. There's a company that grows and becomes part of the S&P 500, and there are companies that basically shrink and disappear, and they're automatically removed from the index. So this is survival of the fittest at best. And that's how the index works. So basically, you automatically get the best 500 companies that make their way to the index. And any companies that do not make their way to the top 500, they get automatically removed from the index. And as a result, they get automatically removed from the ETF by the algorithm. So it's just controlled by a computer, and there's no fund managers that basically get paid an arm and a leg to manage this money.
So it's very simple. It's actually very simplified the way they do it.
It's super simple. So an ETF typically follows a certain index, and as a result, it buys the exact components of that index without trying to outsmart the index, so to speak.
So what is the reason they're not able to match the performance?
That's a very good question. There are multiple studies that have been done around why we call them active fund managers, consistently fail to outperform the index. And before we get to that, maybe let us share with the audience a couple of numbers. And I'm sorry if I don't get the exact numbers here, but I'm going to give you a rough estimates and people can go and check them online.
Okay.
So there is a SPIVA or SPIVA. The SPIVA entity, if you will, publishes every 6 months reports comparing active fund manager performance compared to the benchmark or the index. So they found out that in a single year, roughly 55% or 60% of active fund managers underperform the index. So it's like a flip of a coin. So you have like roughly 50% chance of choosing a manager that does a better job than the broad market. So far, so good. Now, if you stretch this to 10 years, nearly 80% of active fund managers fail to match, let alone beat the index.
Okay.
Stretch this to 20 years and the numbers become really mind-boggling. Over 20 years, if I recall correctly, as per the latest SPIVA report, it shows that only 4% of active managers have managed to outperform the index, and by a small percentage. It wasn't like a huge gap. Now, you could think that, you know what, if those 4% have managed to outperform, well, that's a done deal. Why don't we go and invest with these guys, right? It makes sense. They have beaten the index over the last 20 years. It shows that they have a good track record. Let's go and invest with them. Not so fast. Because again, there are some studies done by SPIVA. I think the name of these studies or reports are the SPIVA persistence scorecards. So these show that usually the funds or the fund managers or those 4% that manage to outperform during a certain period, these funds almost always underperform with the following period. So it's really like trying to win the lottery using last week's winning numbers. It's exactly like that. So the thing is, the managers that have managed to outperform the market during a certain period almost always underperform the market in the following period, which makes us believe that it was mostly chance or luck and not really skill. It's hard to believe, I know, especially that, by the way, I'm not picking on any of these fund managers. I'm sure that they are great financial minds, but it's inevitable. The numbers show that these professionals consistently fail to match, let alone beat the broad market.
As you're speaking, the thing that's coming to me, and I could be way off here, but just intuitively, is that the market is changing and people are doing it the way that they do it. I mean, humans are humans, right? We cannot control everything. We cannot know everything.
Correct.
And it's so nuanced and complex, obviously, the financial market. You can never keep up as a human being. So they're doing what they're doing and they're doing it to the best of a human ability, but they can't be consistent with it because they can't keep up. The market is evolving. So eventually they're going to fall behind, you know.
There is more to it than just that. Because the thing is, these guys that are, like I said, brilliant financial minds. I'm not undermining any of them. These are brilliant financial minds, but these guys don't work for free, right? So basically they charge some fees as part of them managing your money. And there are multiple papers that were done by academics that were trying to understand this phenomenon, why these guys that are supposed to be the best of the best are underperforming an unmanaged index that simply copies, like you said, the components of the S&P 500, for example. So why can't they beat that? Is it really that hard? So they found out that most of these funds, they underperform the market by the exact same amount of the fees that they charge. And I think there is a couple of studies. Maybe we could add those in the show notes. I'll share those with you. It actually shows, if I'm not wrong, the article is the arithmetic. Sorry, I don't want to mess this up. I completely forgot the name of the actual article, but it's an article that was done by a Nobel laureate. So we could basically share it in the show notes, and people can actually go and read and to understand why. I mean, the author says like it's a mathematical certainty that these guys will always underperform the index or the broad market. And like I said, the more you stretch the time frame, and even I've seen studies that if you stretch it to 30 years, an insignificant 1% or less than 1% manage to outperform the market, which is very interesting, because if I get to think about my investment time frame is not just from today until the day I retire, which is what most people think. The investment time frame is from today until the day I die. Yeah. Because basically, even when I stop working, I will not throw a party and then pull my money out from the market and I start spending. Because the way it works is like, there are two phases to your investment lifetime. There's the accumulation phase, where you get to add money to your investment portfolio. And then you reach a point where you start to withdraw money every month or every year or whatever the case might be from your portfolio. So it's not like I pull all of my money at once. My money remains invested, and then you just withdraw just enough to cover your monthly or your yearly expenses.
Yeah.
So going back to this, if in 30 years, as per the studies, and I'm not sure if there are studies that were done for over 30 years, if over 30 years only 1% or merely 1% managed to outperform, why do I have to place my money on a fund manager? And then again, good luck finding the next fund manager that will outperform. So therefore, to me, investing is basically stacking the odds in your favor. And as all the evidence point to, the best way to stack the odds in your favor is by simply investing in the index, which is the unmanaged ETF. That is basically, it costs like, it's dirt cheap. It doesn't cost anything. It's not managed by a professional. And yet it basically is decimating all the professional fund managers.
I mean, the reason why we do this is to eliminate stress and worry in our lives about the future. So it makes sense that you would go with the most safe, reliable method that you feel secure and safe and comfortable with.
Absolutely. I want to go back to returns, right? Mm-hmm. Returns, yes, it's different every year, obviously, with the ETFs. What are type of returns that people can expect, roughly speaking, estimating speaking, over, let's say, 20, 30 years? I mean, for example, could we maybe hear about your accounts, how they've done, if that is not too personal?
Sure.
In terms of percentage-wise?
So basically, the long-term average returns of the stock market is close to 10%. So 10% is the average. However, in any single year, the returns could be all over the place. And funnily enough, we say that the average stock market returns are between maybe 9 and 11%. But over the last 30 to 50 years, you know how many times, just out of curiosity, and that's an interesting thing, you know how many times the returns were actually close to 10% over 50 years? Just pick a guess.
50% of the time?
Twice. 2 times over the last 30 or 50 years. I can check the numbers. Only 2 times the returns were between 9 and 11. So they were close to 10. On the other years, they were either plus 17%, minus 10%, plus 2%, plus 5%. So it's all over the place. So therefore, it's a long-term thing. And the long-term average return is close to 10%. So basically, people usually get this wrong, because sometimes I see people, I invest in ETF, but you know what? I just made 1%. This is despicable. Yeah, right. But you haven't waited that long, right? So 1 year it's +1. The next year it could be -5, and people then will freak out even more. And then the next year is plus 18%. So it's all over the place.
Yeah.
And that person is me. So at the moment, I mean, before I was a very, very safe investor. I had money tied up in ETFs. I started taking a few risks. I will probably get back into investing in ETFs. I will actually get
Yes.
back to investing in ETFs. However, I struggled, like I said, at the age of 32 or 2 years ago, at the age of 30, I struggled to
Detach.
understand the 1%, 2%.
This is important
Yeah.
because we see a lot of comments on the group with people saying, I did it and I only got 2% returns. I feel like it's not worth it. Like, am I
Right.
doing something wrong? Is this
Right.
all worth it? And I know that you always have an answer and you always have a long explanation for these people. And I think that it's so important to relay the message from you directly and connect to the audience as to why it's important to keep going.
Absolutely. But having said that, if someone is planning to invest in ETFs for just 6 months and expecting like astronomical returns, I would tell this person, just don't do it.
Yeah.
Because it's not for that. It's not for the short term. It's something for retirement, something for the long term.
Yeah.
So if you don't have this kind of time frame or investment time frame, just don't do it because it's not going to make you rich overnight.
Yeah, it's a retirement fund.
Correct.
And how about the 3-bucket theory? The buckets where you have your safe investments, medium risky, and a little bit more risky investments. Because this is a type of theory that I hold on to. I don't know where I read it, but it was quite some time ago. And I really hold on to that because obviously I have my safe investment, my safe foundation. I would never not have that. With that has my emergency fund and so onwards. But I always have to have that medium risky and sometimes a little riskier bucket because that can overall increase my ROI year after year. Obviously, it can also decrease my ROI, but I feel that I need to have that, because for me, it's exciting. And I know what you're going to say because I know what all ETF investors say, that if something is exciting when it comes to investing, you're probably not doing it right.
Correct.
But for me, honestly,
It's like a hobby for you.
I wouldn't mind losing a little bit of money, if the investment was fun,
Well, I have another alternative for you. Just go to the casino. No, but
I'd love to.
Okay, let's go now.
in all seriousness. So basically, I totally get where you're coming from. So basically, when we're building an ETF portfolio, I think so far we've covered the equities or the stocks part, right? But if you want to build a proper portfolio for retirement, it's not just stocks. So the best way, again, according to academics, by the way, none of this is my own opinion.
Yeah.
I'm not an investment professional. Like I said, I'm just an IT guy, but this is based on what I've read and basically what the academics say. So basically the best way to build a portfolio, an investment portfolio, is by combining equities or let's say stocks ETF combined with bonds ETF.
So are bonds like guaranteed returns?
Not exactly. Bonds are less risky than stocks, but there's no such thing as guaranteed returns. Bonds are basically debt instruments that are issued primarily by governments, or they could be issued by corporations. But basically, the best type of bonds to be included in investment portfolio are government bonds. They're not horses, but they kind of dampen the blow to stocks. So the idea is to balance between high risk investments that are stocks and low risk investments that there's no such thing as no risk, it's low risk.
Yes.
So
Yeah.
high risk and low risk. Now, if you want to go super risky and if you want to scratch that itch because you think it's fun, it's exciting, or whatever the case might be, I would say the best practice is to maybe dedicate 5%, maybe 10% at most of your entire investment portfolio and invest that into risky assets. It could be Bitcoin, it could be whatever, private equity, whatever you want. I mean, I personally don't do any of this. And in all transparency, I invested just a small sum in a couple of cryptocurrencies, including Bitcoin, Ethereum, and a couple of others. But that was more to demonstrate to myself that it's not really gonna go to the moon. If it goes to the moon, I'm not gonna complain. But if it goes to zero, I'm not gonna care less, to be quite honest. So
Yeah.
this was my risky thing. It's basically less than 1% of my entire investment portfolio. Like I said, if it goes to zero, I wouldn't care. If it goes to the moon, well and good. I'm not gonna complain. So
Yeah.
there you go.
And do you think you would be interested in investing in anything else in your lifetime? Is there anything that has come to you?
Or through research, like has appealed to you or been like an option or possibility or another avenue?
Maybe at some point in time, I might get into real estate investment, but it's not currently my thing. Because like I said, it has a high entry point. I mean, there's a down payment you need to have in place, and then you have the mortgage and whatnot. And this is something that I don't really like that much.
Yeah.
Or maybe at
Understood.
some point in time, I could maybe get into creating a business. It could be like podcasting, it could be YouTubing, it could be anything like that. I mean, I do have a channel, as you probably know, but it's like I do it like a hobby. I never thought about it as a business, but maybe, I don't know, maybe 10 years, 5 years down the line, I might consider turning this into a business.
Yeah.
As long as I'm hopefully helping people out, and if I get paid by YouTube, yeah, why not?
Yeah. Knowledge is valuable. And so sharing that knowledge, I think, should be something that adds value to your,
Exactly.
yeah.
For sure. And on that point of owning property, what do you say about renting to owning? What is your view across that point? Because it's quite a big topic that people speak about in this country.
Well, my point of view is going to be a little bit controversial because I relate more with Ramit Sethi, which is one of the personal finance experts, I would say, out there, and the best-selling author of I Will Teach You to Be Rich. And by the way, he has a series on Netflix by the same name, like I Will Teach You to Be Rich or How to Be Rich or something along those lines. Ramit's take on basically renting or buying the apartment you live in is just don't do it. His take is I'm happy to rent until the end of times, because in most cases, buying a property just to live in does not make a good financial sense. Not always. In some cases it does, but like probably in 70% of the cases, it doesn't make any sense. But people unfortunately have this near religious belief that I need to own my property. And by the way, I was brought up this way, right? And I bought property back home and sitting doing nothing, right? So was it a good financial decision? In my case, I would say no. Was it more of a emotional decision? Yes, but it was a conscious emotional decision.
Yes.
So
Yeah.
I did it, although I knew it wasn't really the best financial choice.
Yes.
So that's totally fine as long as people run the numbers, because usually people defend their choices without being, rational. It's like they're being irrational just to defend their emotional choices.
Yeah.
So it's okay to admit that, yes, I bought a property because it brings me happiness, because I want to feel safe in my own place. That's all well and good, but don't justify it as a good financial choice.
Yeah.
Absolutely. I completely agree with you. I mean, as you know, we've recently bought a townhouse, and it definitely wasn't a financial decision.
It's mixed with emotional. It's like a little bit of a mixture. It's also to say we have a property on our portfolio,
True. And at the end of the day, it's not going to lose value like the crypto market or stocks or whatnot. Definitely the area that we bought in is definitely going to increase in value over time because of the future plans. But I would definitely say with the mortgage and the interest rate and all of that stuff, in the long run, it's definitely the opposite of a good financial choice.
Like there are better ways.
There are better ways to make money.
Yeah.
For sure.
And then again, what I'm saying is it could be a good financial choice, but the thing is people usually do it without running the numbers.
Yeah.
So there is a certain checklist, and people can Google Ramit Sethi and buy versus rent. And he has a very good video on this. I think I once shared it on the group, if I'm not mistaken.
I've watched something on it. So it could have been through the group that you shared.
On Netflix, we've watched.
It was a YouTube
Okay.
5 or 9 minutes video.
Yeah.
And he has a certain, for those who would like to buy, there's a certain checklist to make sure that you are really making a good financial decision. Like I said, in 70% of the cases, it might not be a financial decision, but in 30% of the cases, which is a considerable percentage, it still makes sense to buy the property. So will you live there for 10 plus years? There's a list of questions that he basically lists. So it might be good to go over that video to understand basically whether or not it makes sense from a financial perspective to buy that property. Like I said, if you have the money, or if you take the decision and you understand that's not the best financial decision, and this is an emotional Emotional in a sense that you want that property, although it's not the best financial decision. That's totally fine as long as you're conscious of the choice you're making.
Correct. Yeah, absolutely. I completely agree.
I think that financial confidence comes in here because a lot of people will say that the best financial decisions are not emotional. But at the end of the day, we are human beings and we are emotional beings. And so when we are making moves and doing things that we enjoy in terms of investing, it gives us more hope, it gives us more confidence, and therefore we make more moves within that space. It's like experience, it's like we make more moves within that space and we actually open up doors for ourselves. We give ourselves more chances. Now, I'm not speaking about the most sure way to save for retirement. I'm speaking about investments in general. For us personally, we enjoy, it's like a hobby. It's something that is a big part of our lives. We enjoy expanding our portfolio, buying property, buying into businesses, speaking about the possibilities for our future, speaking about our hopes for the future, what we would like to get into. We'd like to invest in some art. And it also encourages us to have more hope for the future, make more moves, and therefore give ourselves more opportunity. For example, people in Dubai who are very big in the investment game, or they're very involved and they like to buy property, for example. If they had bought in Dubai Hills in 2020, they would have quadrupled their money.
Totally. Yeah.
Today. And they wouldn't have made that move if they were a beginner. They wouldn't have made that move if they had just gotten into investing. The people who made that move were most likely people who are putting their hands in different pots and different
they
pies.
got some tips, right?
Yeah. So for me, I'm a dreamer. And we all function differently, right? For me, I'm a dreamer. So if I don't have that dream, I'd rather just not get involved at all. That's my personality. I need this hope and this dream and this vision. It's about vision and fantasy. And then I'll get involved. And therefore, I have more chance of succeeding. So I think it's more nuanced, I think that there's a nuance to investing. Would you agree?
Sure. I mean, I could answer for myself, and I totally understand where you're coming from. In my case, my ultimate objective was financial independence. Maybe we haven't touched base on this topic before.
Yeah.
Financial independence for me, it was a big aha moment for me when I discovered financial independence. And to me, financial independence is where you reach a stage where you have enough wealth or passive income so that you never have to work again. And that doesn't mean that you will not work or you will stop working. It actually gives you a choice, because once you're financially independent, you could choose to continue working if that's what you like to do. You could maybe quit your job and do something else that you like, maybe less stressful, or you could volunteer and work for free for the rest of your life. So I'm not suggesting that you stop working at all, because basically even studies have shown that people that retire early and do nothing, they have higher risk of dementia, they have higher risk of dying of a heart attack and whatnot. I mean, all kind of health problems. Yeah. So the idea is, again, I'm stressing on this point because just to convey the message that financial independence is not reaching a point where I would simply lie on a beach and do nothing. It's just reaching a point where I have the peace of mind that whatever happens, I can provide to myself and my family. And this, to me, that was my biggest driver. Yeah. And then after I started my research, I found the formula, so to speak, to financial independence, which is super simple and very achievable to do with ETF investing. Now, again, why ETF investing? It could have been something else. So again, there are multiple ways to reach your target here. But to me, the reason why basically ETF was my choice is because A, it's easy. B, it's backed by tons and tons of academic evidence. And we have lots of history that show that it actually works. And I have seen friends that have achieved this level of financial independence using ETF investing. And just to name a few, I'm going to name Sebastien Aguilar, which is the founder of Simply FI, which is the other Facebook group I'm also a member of. Sebastien, actually, he's a gentleman from Belgium who came to Dubai by age 26. He made a couple of money mistakes by investing in those, dreaded insurance-linked schemes that are basically the worst investments ever.
Yeah.
But then he discovered the power of ETF investing, and by tuning his lifestyle, by living a little bit frugally, by increasing his income, lowering his expenses, and by investing that gap between his income and expenses, he was able to retire in just 7 years by age 33.
Wow.
Now, this to me was, it's not something for everyone, because that means that you have to live frugally, that you have to live in a non-conventional way. It might not be for everyone, but it's possible for those who set their North Star and they work towards it. It's totally possible. And there's an entire movement that is called FIRE, Financial Independence, Retire Early. And like I said, ETF investing or index investing is not the only way to reach there, but it's a sure way to reach there. So it's a proven way to reach there. And that's why I kind of gyrated towards ETF investing as opposed to, let's say, investing in venture capital or some other stuff or real estate.
Yeah, so actually we see Simplify everywhere, all over Facebook. And whenever I see people on Facebook groups asking, how do I reach my goal financially here in the UAE? It seems that rentals are so high, etc., etc. I'm always there commenting, come and join us on UAE, Grow Your Finances. And people are like, no, join Simplify. This is the place to be. And I'm like, no. This is not a competition. Join both. Get as many perspectives as you can, and we're part of Simplify. And actually, for me, I'm not financially savvy at all. Like, I just don't have a financial brain. So for me, I get scared of these types of groups. I feel like everybody's more knowledgeable and advanced, and they're speaking in a language that I don't understand. I like to bring in the psychological side of things and be able to grasp things from my own perspective. I'm more of a creative brain. So I like to draw a full picture for myself and see all aspects, So it looks like a very interesting group to get into. And Elie is one of the admin of Simplify. So it's great to have that perspective here with UAE Grow Your Finances too. We fully appreciate having Elie on our group because he is the expert in this area. So whenever there's a question about ETFs, I always tag Elie and I'm like, you answer. I don't know.
And by the way, it did not really start this way. I joined Simplify. I was just a member, and I was just contributing and sharing and asking questions. But then I noticed that I could answer a certain number of questions. And then I got contacted by Sebastian and he asked me, would you want to join us and be part of the board and part of the admin group? I said yeah, why not? But I'm a nobody. This is not something I'm expert with. He said, you don't have to be. It's just a matter of just share your experiences. And that's pretty much it. So, and this is how it happened back in, I remember it was COVID, so I think it was either March or April of 2020, if I'm not wrong.
Okay.
So I've been actively part of the Simplify group since, let's say, March or April 2020.
And you're very active. You're always there answering people. So it's quite amazing.
I'm less active than I used to be totally fair.
You're a great resource, I would say. Very
Absolutely.
Active. Yeah.
Let's talk about some mistakes that people make, because we're talking about the risky, we're talking about the safe. Let's talk about those innocent, I would say
naive, yeah.
Better word, mistakes that people make in the long run. Have you made any of those mistakes? We would love to know.
Yes, I am basically your typical guy that has done all these mistakes, or the majority of these mistakes. I've done them all. So starting with, to me, the biggest mistake that anyone could do here in the Middle East or in the region is trusting the wrong financial advisors. Out of all the financial advisors in this part of the world, you could possibly find maybe 5 or 10 at most that are true fiduciaries. What is a fiduciary? A fiduciary is someone that advises you without having any skin in the game, because most of the advisors, they are just sales brokers in disguise. And this is the case in the most regulated countries such as the US, the UK, etc. Yeah. So if in these countries you have such a gray area where these financial, I would say, not advisors, these financial salesmen get to do what they're doing. It's the wild, wild west in here, unfortunately, because although there are some regulations in place, but these guys always find ways around them.
Yeah.
So let me quickly tell you my story. I basically, since I didn't know anything about investing, back in the day, I trusted one financial advisor who advised me to buy into one of those insurance/saving plans. These are really the worst. So basically, I ended up losing a lot of money. And then after learning about these plans, I discovered how bad these were. So these are typically plans that will lock you in. You cannot get your money out without paying a ridiculously high surrender penalty. And the reason behind this is the first 18 months worth of your contributions go straight into the pocket of the broker or the salesman that actually sold you this policy or this plan. So basically, if after 16 months, or let's say 1+ year, you want to withdraw your money, you can't take anything at all. It's like zero. Yeah. Why? Because the thing is, they show you on your balance sheet that you have a number, but if you want to withdraw your money, you have to pay a penalty of, which is more or less equal to everything you've paid. And then the thing is, they charge you 4.5% in fees. Now, people might think, what's 4.5%? This is nothing, right? It's like a waiter's tip. But unfortunately, if the stock market or if your portfolio, which is a mixture of stocks and bonds, make on average 8%, and if you're paying 4.5% in fees, that means you're giving away more than half of your profit to the broker.
Yeah.
Now, this doesn't look that bad. Now, extrapolate, or basically after 20, 25, or 30 years, this 4.5% will translate into 2/3 of your total investments. So imagine yourself, you're investing, say, $500 a month, right? Now, just doing the quick math, $500 per month, if you invest that in a portfolio of ETFs, let's say in 30 years, you will end up having close to $1 million, which is amazing, right? If you invest the same amount, $500, into one of these plans, you'll end up with, if you're lucky, $300,000 or $350,000, which is okay. It looks fine. But where did that $600,000, $700,000 disappear?
Yeah.
They all went up in smoke in fees. So that 4.5% in fees per year over 30 years, it will snowball into a whopping 2/3 of your investment pot.
And I get a lot of DMs, as well as there's a lot of messages on the group about people that are stuck in these funds. And it's a pity, it's a pity to see that it's almost like these funds are stealing people's money. You have to be so cautious. You have to read all.
The thing is, even if you read everything, even if you read the 40 pages of terms and conditions, the fee structure is so evasive and it's so hidden that you don't get to see it. And I fell for that not once, not twice, but thrice. I had 3 of these plans, and I ended up, I surrendered them all like a few years ago when I first discovered the power of ETF investing, and I never looked back. And the thing is, one typical mistake people make in those plans is that even when you shed some light about how bad they are, or about how bad the fees or the hidden fees are in these plans, people usually would like to stay with them until they break even. So this is a mirage, because the thing is, if you just stop your loss, and even if you surrender at a loss, if you invest whatever you could salvage in a portfolio of low-cost ETFs, over the same period of time, you will still get it. You will still be ahead. But people don't realize this. They'll say, you know what? I lost like maybe $10,000. Let me wait a few more years and then I'll break even. So that's the wrong way to think about it, because there's a huge opportunity cost by just doing this.
You have to kind of pull off that plaster.
Totally.
Right? Cry yourself to sleep that night, wake up the next day and invest it in the right place.
And we have a resource here in the UAE, save.ae. We've had the guys from save.ae.
Yes, I know the guys.
Yeah, and they're doing brilliant things.
So these are one of the very few trustworthy advisors in the area. So like I said, you could basically count them on 1 or 2 hands at most.
So I had 2 financial advisors in my life. One was in South Africa, And then another one I had when we came to the UAE. Both of them I did terribly bad with in terms of fees, and I had to surrender a lot of money. So
I mean, it's part of the whole reason why we are on a mission to empower people to manage their own wealth and
Yeah.
to grow their own wealth. Yeah.
I would say the financial industry pushed us to start the group. So
Yeah.
at least something good came out of it.
Yeah, that's exactly why I do what I do now, because
Yeah.
I don't want people to fall prey to these financial sharks in the region.
And the worst thing is the fact that how people are they don't have a clue when it comes to investing. A large majority of people on this earth know nothing about investing, and these are the type of people that will get sucked into these funds.
Exactly.
I think a very big reason for that is that people think that it's really complicated. And what you're saying is that it's actually really simple.
It's super simple, but it's not easy. And
Yes.
I'll explain why it's simple but not easy. Let's start with the simple part. Simple as in it's just as simple as opening a trading account, buying a couple of ETFs using a ratio according to your risk tolerance.
Okay.
And all you need is a total stock market ETF and a bond market ETF using a ratio according to your risk tolerance. So the riskier you want the investment to be, I mean, if you increase the ratio of stocks, then it's riskier, but you have higher expected returns. If you increase the bonds ratio in the portfolio, it's less risky, but then again, your expected returns will be slightly lower. So therefore, people usually use 80% stocks, 20% bonds for a, let's say, roughly aggressive allocation. Some people go 100% in stocks, although they must have guts of steel if they do that. Then you have 60-40, which is somewhere in the middle. And I personally wouldn't advise anyone to go anything more conservative than this. So nothing like 60% bonds, 40% stocks. Maybe for very old retirees, maybe, but for most people, I don't think that would be necessary.
On this point, when you said stocks, you mean ETFs, right?
Yeah. So
Okay.
ETF, like I said, ETF is a basket. So it could be a basket of stocks or it could be a basket of bonds. So by having a portfolio made of just two ETFs, one stocks ETFs and one bonds ETF, you practically own the whole.
Correct. I don't want people going and putting 60% of their funds, in individual stocks, because we're not talking about that.
No.
Just to make it clear.
Yeah, totally. And individual stocks, again, there are studies that have shown time and again that picking individual stocks doesn't work. So unless your first name is Warren and your last name is Buffett, just please don't do it. And don't tell me, please, my cousin did it and made a lot of profits last year, because even if he did, good luck for him to repeat the same streak over and over again.
Yeah.
Again, you could get lucky, but I'm saying
Yeah.
that
You can't depend on it, of course.
exactly. So
Yeah.
I don't know about everyone else, but as far as I'm concerned, if I want to invest my life savings, that would be better something which is proven to work. So I'm
Yeah,
not
yeah.
gonna invest everything I have in a stock. If it flies, it can go
Yeah.
to the moon. But then again, if it crashes, then my entire savings go down the drain. So I'm not willing to take that risk. But like I said, if you have a solid foundation of having a, let's say, a balanced portfolio of stocks and bonds, ETFs, and then you have 10% play money, you want to invest in something super risky, be my guest,
Yeah.
as long as you have a strong foundation in place.
Yeah.
So how many ETFs would you say you have in your portfolio?
I have more than just two because I follow a non-standard ETF portfolio, but this is not for everyone. So what I usually advise people is to have a single stock ETF, which is for most people that are non-Americans, I would say VWRA, which is the Vanguard FTSE All World. So it's one ETF that has close to 4,000 stocks in it. And then another ETF for bonds, which is IGLA or the iShare Global Government Bonds.
These are the two that I had when I used to invest in
Oh, really?
ETFs. Yeah.
Oh, wow.
So
I
that's
think I followed you.
that's basically all you need, right?
Yeah.
Now, I make it a little bit more complicated. So I have a portfolio that follows what we call a risk parity portfolio. It doesn't zigzag as much as the typical portfolio, but then again, my expected long-term returns are slightly less than an equivalent portfolio of, say, 60% stocks or 80% stocks, 20% bonds. So it's not a racehorse, but it's more stable. I mean, I'm 49 years young. So to me, I feel much safer in a portfolio that follows the golden butterfly or the permanent portfolio kind of construction. I don't want to get into the specifics because it gets a little bit more complicated. We don't want to scare people off. So we're saying that this is super simple, and I don't want people to get to think that this is more complicated than it needs to be. So this is as simple as it gets. And if people still think that this is too complicated for them, what I would recommend them to do is to use the next best thing, which is a robo-advisor. We have a couple of them in the UAE. But basically, if you just subscribe or if you just open an account with a robo-advisor, the robo-advisor works this way. It asks you a list of questions to identify your risk tolerance. And once they define your risk tolerance, they automatically invest your money in a portfolio of ETFs, and they do all the management for you. So you just continue pumping money in your account and they do the investment. So it's as hands-off as it gets. So for those who think that managing your own portfolio, which consists of 2 ETFs, is too complicated for them, fair enough. There's an easier solution. For a very small nominal fee, a robo-advisor can manage everything for you. It's still low-cost ETFs. For a very small nominal fee, they can manage everything for you. So
there's no excuse.
Totally. There's no excuse for those who believe that this is too complicated.
Yeah.
I would say the best step to do it, I would recommend someone trying the robo-advisor, probably to set up a small account and see how it is. And during this time, learn, ask questions, get involved, search on Google, ask on our group where they...
Ask on the Simplify group.
Yes, both groups. And how should I do it? What should I invest in? There are many people on both groups that invest in ETFs, and I'm sure they would guide you very happily because they believe very strongly in ETFs.
Yeah. While we're on the topic of it being simple, how do we start? So if I were to, with absolutely no knowledge right now on anything, start. Say I have 500 dirhams.
Excellent. So you have 500 dirhams. I would simply open an account with one of the robo-advisors in the UAE. And by the way, they are highly regulated and your money is safe with them because they use an underlying, we call them custodian. So the money is not with the company itself. So even if the company goes bust, your money is still safe.
Okay.
So the way it works, like you open an account, you could download their application, and in like 5 minutes or 15 minutes, you could answer a few questions, upload your Emirates ID, fill in a couple of personal information. You could even link your account with the robo-advisor with your bank account so that you could automate your transfers on a monthly basis or maybe on a quarterly basis to your investment account. And by the way, it's entirely up to you. You could invest every month. You could invest every year. You could invest a lump sum and never invest a single dime anymore. So it's entirely up to you. It's not like those plans where you have to pay, otherwise you get a penalty.
Okay.
So this is very important. And another point is you could withdraw your money at any time. It's not that you would want to, because basically our objective is to let that money grow, because the minute I withdraw the money, it stops growing, right?
Yeah.
So therefore, maybe before we start investing, I would say if you only have 500 dirhams and you have nothing else, what I'm going to say is going to be a little bit controversial. Don't invest. Why? Because before you invest anything, build your emergency fund. What's an emergency fund? It's basically cash you set aside in a typical bank account. Keep it super simple. Keep it in a bank account. So the guidelines is to have between 3 to 6 months worth of living expenses. Maybe some people who are starting up do not have 3 or 6 months of living expenses. I would say at least have something. If an emergency happens, so you have something to fall back to. Don't invest all your money. Have an emergency fund, even if it's like, 1,000 dirhams, whatever it is.
Yeah.
Have some money put aside and then build it up until it reaches the stage where it's like 3 or 6 months worth of living expenses.
Yeah.
And the reason behind this is because, like we said, the stock market rises over the long term, but in any given year, the returns could be negative. What if you had an emergency and you need 50,000 dirhams and that money is actually invested, and that 50,000 invested during a bad year is now 30,000. So what do you do?
Yeah.
So that's why it's important to have an emergency fund before you start investing. And there's another point, which is even more important than the emergency fund. Please do not invest if you have a single dollar or if you have a single dirham of credit card debt. Please please pay off your credit card debt before investing or even starting to build your account. Because let me ask you a question real quick. Do you have any idea what is the typical interest rate of your credit card?
I have absolutely no idea.
From the top
Do you
of your
know?
head.
I don't even know, no.
Yeah.
But I've never ever had credit card debt that I don't
Neither. Yeah.
Yeah.
From the top of your head, could you
I
try to-
I don't know why 12% is in my mind.
Okay, what if I tell you it's 45 or 46%?
God.
My gosh.
It's ridiculously high. So there's no investment on planet Earth that can outperform this kind of
Yeah.
that kind of interest.
Oh,
So
that's scary. That
I always tell people investing while having credit card debt is like trying to fill a bucket with a huge hole at the bottom of it.
Yeah.
So it makes absolutely no sense. So you're basically filling a leaking bucket. There's no point.
Those
Yeah.
are some really good tips.
Yeah, we always talk about the emergency fund, but we leave out the credit card debt because we forget that a lot of people actually do
Yeah,
That's
have
very
this.
important.
Yeah.
That's very important.
I only use my credit card to spend on, but I always pay it back, I would say every 2 weeks.
That's exactly
Make
what I
sure
do.
that I don't lose this extra
Yeah.
money.
And if I may, I have another tip for you. This is something that I use with my own credit cards. I set up an automatic settlement so that I don't have to pay it myself. So I charge everything on my credit card, and people say, why do you use, but I thought you're against credit cards. No, I'm not against credit cards per se. I'm for using credit cards. However, you have to use them the right way. And
Yeah.
the right way to use a credit card is to basically use it like a debit card. In
Yeah.
fact, I would rather suggest to never use your debit card to pay anything. Not at the restaurant, not at the point of sale, nothing. Why? Because if your debit card get hacked or get compromised in one way or another, and it happened to a friend of mine, their account was basically wiped clean.
Wow.
Wow.
And there was absolutely nothing they could do. Yes, they raised a complaint and whatnot, and it's been like a couple of years and they got nothing.
Yeah.
However, with a credit card, if your card is compromised, you just call your credit card company or your bank, they block it and they reverse the transaction. That's done. It's not
Yeah.
your money. It's the bank's money that you're using. So if you're using a credit card, make sure you have at least some setup in place to pay it off automatically each month.
Thank you so much, Elie. It's been a fantastic episode. We've learned a lot. I know I have.
Yes.
Have you?
Absolutely.
And we definitely would be putting money in ETFs very soon. But where can our listeners find you?
They could primarily find me on my YouTube channel, Wise Investor Middle East. My handle is Wise Investor ME, one word, on YouTube, Instagram, TikTok, pretty much on all socials.
Great.
Fantastic. And guys, head over to Elie's pages. Give him some likes, give him some shares, follow him.
And engage with him on our group. He's always there.
Always
ready
there,
to answer.
always ready to answer all of your questions. So thank you so much for that, Elie, and thank you so much for coming to visit us at our new townhouse.
And thank you for saving us reading 30 books.
Thanks again for having me. That was really fantastic. Thank you.
So guys, please go check out Elie's social media channels. Go check out Elie's YouTube channel. Go ahead, check it out, subscribe, show him some love, put some likes on his videos. He's a great guy. He works really hard and he does so much on our group for absolutely nothing.
What we really value about Elie is that he shares valuable information completely free. So you can learn from him and his mind and all of his time spent on researching for absolutely free, which is one of the best gifts you can give to yourself. So thank you very much, Elie, for that. And guys, go on and indulge yourself. Learn some more. Make lots of money.
And on that note, guys, please pay yourself first because you are worth it.